Good day, ladies and gentlemen. Welcome to the Enablence Technologies Financial Results Conference Call. The presentation of the information on this call may contain forward-looking statements that are made as of the date hereof and are based on current expectations, forecasts, and assumptions which involve risks and uncertainties associated with our business and the economic environment in which the business operates. These risks and uncertainties include, but are not limited to, the divestiture of the systems segment, pricing competition, dependency on new products development, reliance on major customers, customer demand for our products and services, control of costs and expenses, international growth, general industry and market conditions and growth rates, and general domestic and international economic conditions, including interest rates and currency exchange rate fluctuations. All such statements are made pursuant to the safe harbor provisions of and are intended to be forward-looking statements under applicable Canadian securities legislation. Any statements made during this call that are statements of historical facts may be deemed to be forward-looking statements. For example, the words anticipate, believe, plan, estimate, expect, intend, should, may, could, objective, and similar expressions are intended to identify forward-looking statements. By their nature, forward-looking statements require us to make assumptions and are subject to inherent risks and uncertainties. We caution our listeners on this call not to place undue reliance on our forward-looking statements, as a number of factors could cause actual results, conditions, actions, or events to differ materially from current expectations. Enablence does not intend and disclaim any obligations, except as required by law, to update or revise any forward-looking statements, whether as a result of new information, future events, or otherwise. I would now like to turn the meeting over to Mr. Tim Thorstensen. Please go ahead.
Thank you, Operator, and welcome to the Enablence year-end fiscal results call for our fiscal year. Before we review the year and the quarter, I'd like to provide an update on the planned divestiture of our systems businesses. We announced on April 28th that we were starting a process to exit our systems businesses. On September 15th, we were successful in selling the majority of the U.S.-based systems business to Aurora Networks and FX Support. We transferred $2.4 million of liabilities and received $2 million in cash, with up to another $750,000 to follow over the next year. We still maintain a piece of the U.S. systems business related to the former Panaway acquisition as it relates to supporting our customers. As of today, we have not completed the sale of the teledata business. However, we continue to explore all strategic alternatives with potential buyers for the most value-enhancing divestiture. The sale of the teledata business has proven more challenging than we initially expected, and we hope to bring this process to a conclusion by the end of this calendar year. We cannot provide any more specifics on the sale process at this time with respect to potential valuations or ultimate outcomes, and continue to keep all of our strategic options open. I'd like to now turn the call over to our CFO, Dave Tays, to update you on Q4 and the full fiscal year results, and then I'll provide an update on the business. After that, we'll take questions from analysts at the end of the call. Dave?
Thanks, Tim. I'd like to start by clarifying the periods about which I will be speaking. As you know, we've changed our year-end from April 30th to June 30th. Therefore, our comparative figures are for different time periods. Our fiscal figures are for the 14 months ended June 30th, 2011 in the current fiscal year, compared to the 12 months ended April 30th, 2010 in the prior fiscal year. Our current quarter ending June 30th, 2011 is compared to the prior year quarter ending April 30th, 2010. As a result of our decision to exit the systems business, we've reclassified the operating results from systems into discontinued operations. The financial information that I will focus on will be that of our continuing businesses, which is focused in one segment, optical components and subsystems. Our financial results are compiled using the same accounting standards as prior periods and are presented in Canadian dollars. Because of changes to accounting standards, we will be reporting our financial results using IFRS, starting with the quarter ending September 30th, 2011. We will also be changing our reporting currency to U.S. dollars to better reflect the underlying economics of our business. We will be restating our fiscal 2011 results to align with these changes. Revenue for the current fiscal year was $35.3 million, compared to $23.4 million in the prior fiscal year. After removing the impacts of the 2 extra months in the current year and foreign exchange, revenue increased by 41% year over year. This growth was driven by our VMUX and AWG products, for which we saw a significant increase in demand, as well as photodiode revenue, which increased 75% from the prior year. Revenue for the current quarter was $5.5 million compared to $6.9 million in the prior year quarter, a decrease of 21%. We saw a slowdown in purchases as a result of inventory corrections by our customers and a slowing of telecom purchases during the quarter. While we believe this slowdown is temporary, we do not expect a significant increase in revenue for our quarter ending September 30th, 2011. We believe the end markets continue to be strong for our photodiode, engineering services, and optical components offerings. Gross margin for the current fiscal year was 27%, compared to 21% in the prior fiscal year. The 6% improvement was driven by increased volume, as we spread our fixed costs over a larger revenue base, as well as our success at offsetting pricing pressures from our customers with cost reductions. Gross margin for the current quarter was 20%, compared to 25% in the prior year quarter. This decrease of 5% was mainly due to volume. However, the company did record approximately $400,000 in non-recurring inventory charges in the quarter. These costs were partially offset by the savings realized from the successful consolidation of our operations in California. As you'll recall, we initiated a process to move our Wilmington, Massachusetts operations to Fremont, California. Operating expenses, comprised of R&D, sales and marketing, and G&A expenses, increased by $2.4 million, or 19%, compared to the prior year. The main driver of the increase is the additional 2 months in the current fiscal year. The company reduced sales and marketing expenses, which was offset by increases in certain consulting expenses during the year. Operating expenses in the quarter are down over $300,000 from the prior year quarter due to cost reduction initiatives. Adjusted EBITDA, a non-GAAP measure we use to measure the ongoing operations of the business, was a loss of $3.6 million for the current fiscal year, as compared to a loss of $6.3 million in the prior fiscal year. Adjusted EBITDA removes the impact of non-cash and non-operating related elements. The improvement in adjusted EBITDA was driven by the revenue growth and margin expansion compared to the prior year, offset by the increase in operating expenses. For the current year quarter, adjusted EBITDA was a $1.8 million loss compared to $1.6 million in the prior year quarter due to the decrease in revenue, partially offset by the reduction in operating expenses. Included in the current quarter is $369,000 of restructuring costs, which represents the final costs to relocate our Wilmington operations to Fremont. This move is now substantially complete, and we expect it to generate $250,000 per quarter of savings as a result of the move, and we realized a significant part of that savings in our fourth quarter. As I mentioned, we've reclassified the system segment as discontinued operations. For the current fiscal year, our loss from discontinued operations was $92 million compared to $18 million in the prior fiscal year. The current fiscal year loss from discontinued operations includes $60 million of impairment charges on goodwill and intangible assets, as well as a $7.4 million restructuring charge related to the sale and downsizing of our U.S. systems business. The current year also includes a $1.1 million inventory charge. The loss from discontinued operations in the current year quarter was $37.7 million compared to $3.2 million in the prior year. The current year quarter included $22.7 million of impairment charges, as well as a $7.4 million restructuring charge. Revenue recorded in discontinued operations was $6 million for the current year quarter. Let me shift now to discussing our cash position. At June 30th, we had a total of $11.5 million of cash, including $1.5 million held in discontinued operations, compared with $8.5 million at March 31st, which included $3.6 million held in discontinued operations. The company also had $3.8 million of restricted cash, including $2.5 million of restricted cash in discontinued operations. The increase in cash of $3 million from March 31st to June 30th was due to the $10 million we raised in May of 2011, offset by $1.2 million used to secure the China joint venture loan, $1 million to repay our operating lines that were outstanding at March 31st, $600,000 for debt service costs, $1 million used in continuing operations, and $3.3 million used in discontinued operations. We currently have $9.6 million of cash, including $1.6 million held in discontinued operations. I will now turn the call over to Tom.
Thanks, Dave. I'd like to start by outlining how we plan to improve our business moving forward outside of the work we still need to do to divest the remainder of our systems businesses. Our primary focus is to grow our revenue, improve our gross margins beyond where they are now, manage our working capital and cash flow, and importantly, launch the China joint venture. While the inventory correction we saw in the June quarter is disappointing and was seen by many of our competitors, we believe this is a temporary setback and that our addressable market will grow at approximately 15% a year over the next 3 years. In order for us to exceed this growth rate, we are first adding more sales and marketing resources to expand and broaden our customer base, identifying and addressing adjacent markets for our products, such as defense contractors and datacom providers. For example, we sold a number of 80-channel MUX, DMUX boxes to a Tier 1 Internet provider for its data center over the last couple of quarters. We're expanding our product portfolio through continued product evolution with a focus on products that address the growing need for faster and more flexible networks, and we have some technical differentiation in this area. And finally, we're identifying new products through our engineering services activities. We are launching our China joint venture to provide higher volumes and access to the Chinese market for our optical components based on our proprietary PLC technology, with the initial focus on optical splitters. The company's initiatives to drive gross margin improvement beyond growing revenue include continuing new product development and portfolio evolution, leveraging the China joint venture to improve our volumes, and it's a place where we'll have much reduced costs for manufacturing, and realizing the benefits of our recently completed operations consolidation in the U.S. Enablence plans to grow its revenue in part through its investment in the joint venture. The company funded its $3.5 million cash investment in the Chinese joint venture during the quarter. Highlights of the China JV are as follows. Our partner in the joint venture is China's Sunsei Telecommunications, the leading provider of cabinets and infrastructure products in the Chinese market. The JV gives us access to low-cost manufacturing in China and a platform to aggressively enter the market for optical components required for broadband telecom equipment. The JV build-out is being finalized in this December quarter. We would expect to see first wafers off the line in this quarter, and we expect that the JV will start to generate revenue in the first quarter of calendar 12. The initial focus on the joint venture is splitters. However, we will expand the joint venture into PLC-based modules and transceivers, as we believe our joint venture partner will help us gain access to the large and growing market in China. In its first 12 months of operation, starting January 12th, we expect the joint venture to generate revenues of approximately $10 million and to grow significantly in the following year. We expect the JV to be accretive to our adjusted EBITDA within the first year of operations. Outside of the joint venture, we continue to work on expanding our product portfolio through existing product evolution and through new products identified through our engineering services activities, including the integration of high-speed capabilities, 40 and 100G, across our product offering, development of multi-channel 100G optical components aimed at the long-haul metro loop and datacom optical fiber markets, including TOSA ROSA products, and expanding our multi-cast switch to higher port count switches for next-generation reconfigurable multiplexers to enable a more dynamic and agile optical transport network moving forward. We are also increasing our value add in photodiodes with added packaged photodiodes and higher speed avalanche photodiodes. To summarize, in the very near term, we continue to be focused on the divestiture of the remaining pieces of our systems business. We believe we have growth opportunities and technical differentiators in the optical components market and are excited about the growth opportunity we have through the China joint venture. At this time, I'd like to turn it back to the operator, and we'll take any questions that you may have on the line.
Thank you. If you have a question and are using a speakerphone, please lift your hands up before making your selection. Please press star 1 at this time if you have a question. You may press the pound sign to cancel your question. There will be a brief pause while participants register, and we thank you for your patience. The first question is from Dev Bengai of Fraser McKenzie. Please go ahead.
Morning, Tim and Dave.
Good morning.
Morning.
So, Tim, just kind of reviewing what we spoke during the last conference call, we were talking about overall revenue for the year of 35 to 40 million run rate at 35 to 40% gross margins as being the objective. I guess, given the revenue right now, are you expecting about 4.5 to 5 million per quarter, which is about 16 to 20 million per year from the China JV?
The China JV, again, we'll start producing revenue in the first quarter of next year, and I think our target for the first year is
$8 to $10 million.
in the $10 million range revenue.
Okay, so if it's 10 million there, then about 25 to 30 has to come from existing business, right?
Right.
So that means from the current run rate of 5.5, and I think the next quarter's guidance is also more or less flat, like the 5.5 that we just reported in June, then there has to be significant growth based on a non-China business from whatever the level is, 5.5 to 7.5, isn't it?
Yeah, we think as the market starts to come back, we'll get back to, back towards the numbers we were producing with the core business before the joint venture. So I don't think the business is going to stay in the $5.5 million range longer term as the market comes back and as we introduce new products. So I don't,
Okay, and then
we're hoping that was that it's not going to stay at that rate as we move forward.
And Tim, how are we going to raise the margins from the current 20% level to 35 to 40%?
Well, I think if you go back and look at the year, just give us a second here. The margins on the components business for the 4 quarters were
In the low 30s.
Yeah, in the low 30s. This quarter we had $400,000 of inventory write-off that cost us a number of points. So if you go back in the March quarter, we were at 32% gross margins. In the December quarter, we were at 33% gross margins. So we have been operating in the low 30s. That's before we shut the Wilmington facility, and the gross margins on the joint venture should be, accreted to our overall gross margins. So I think that 35, percent and above number is a more accurate reflection of where the business will get over the next few quarters. So I mean, this last quarter again, with the drop off in the revenue from a couple of large customers that I think are going through an inventory adjustment of their own. We took a hit there. We had $400,000 of inventory write-off as we started to clean up the balance sheet in the business. So I think it was kind of an anomaly. I think we can get back to the low 30s rate, and again with the Wilmington shutdown, it's going to probably give us another 2-3 points a quarter. JV will give us a little bit more. So I think that 35 to 40 range is a better longer-term target for the business.
Okay, thanks. My second question would be on the cash drain. Like, how much is the cash drain right now per quarter from the discontinued operations, and how much is the overall cash drain per quarter?
What's left, obviously there's no cash drain left on the North American systems business to speak of. I think, that's been pretty much eliminated. And to date, the teledata business has been not burning cash. So we haven't been consuming cash from discontinued operations.
Okay. And what is the overall cash burn then?
This last quarter, I think we were 1.8 EBITDA negative. There was some extra corporate spending in there as it relates to the divestiture of the businesses. So we expect the cash burn to be reduced going forward and to turn positive in the second half of the calendar year that we're moving into.
Okay. Now,
so we're again, that's where we are on the cash situation.
Okay, because I was asking you more from the point of view when it says that the IP transfer to the Sansei will actually happen in December, which means that based on the PLC technology, those guys will start producing in the first quarter of the calendar year 2012 and probably will ramp in the second quarter. So by the time you'll be ending your fiscal year in 2012 June, and that will be the last quarter that the JV will see some kind of a growth, given that the IP transfer will occur in December. Is that a correct kind of characterization?
We show the joint venture ramping through the year, getting to full production near the back end of the year. Mm-hmm. But I'll be over there next week. We're getting it to ramp as quickly as possible because we have a customer already for the product we're building. So, as soon as we can make the splitters, we're going to consume them. So, they're going to be internally consumed for the first probably 3 quarters at least.
Okay. And then last question, and then I'll stand back in the line. Tim, or I guess Dave would be, there is a total debt, long-term as well as current, of $20 million, of which 12 is the current portion, and of which there's a note which is coming due in June 2012 of $10 million. How are you guys trying to refinance or pay this back or whatever it is, given that the current cash on the balance sheet is $10 million and still we are consuming some kind of a close to $2 million burn, or maybe a little less than that per quarter?
We expect that we'll be approaching cash positive at that point. We'll be able to refinance that note, the $10 million note that comes due in June.
Okay.
Thank you.
Thank you.
Thanks.
Once again, do not hesitate to press star 1 if you have a question. The next question is from Daniel Kim of Paradigm. Please go ahead.
Morning. Thank you. Gents, I wanted to go back to the JV. Tim, could you, first of all, give us a sense of if there could be any more potential delays to getting this JV started? It sounds like it's only mechanical now in terms of moving over equipment and laying down processes. Just want to make sure that the start of the new year is, in fact, going to be there with any other potential hiccups.
The JV initially slipped 90 days because we were 90 days late injecting our $3.5 million of capital. So the slip up in the schedule at all has been that it took us longer than we had hoped it would to inject our capital. Everything's on schedule today, and all the equipment will be on site within the next 30 days. They've currently hired 25 employees, and we'll have 60 employees by the end of December. And we'll be doing prototype production runs in November and December. And, we may see a very small amount of revenue in this current quarter, but we're not counting on any. So we may see a little, and we'll start to ramp in the first quarter. And as I said, Sansei is going to consume the first several quarters of production. So, everything's going pretty much according to plan. The only delay has been our injection of our capital, which was 90 days later than it was supposed to be. But we've got a strong general manager running it, and one of the key engineering people from Wilmington transferred there and is the VP of engineering. And A&D Devices knew how to make splitters in the past, so it's a technology that we're comfortable with. A team of people is going from Fremont to China to train the technicians and the operators. So, I'm feeling very good about our ability to start ramping that business in January as quickly as we possibly can to get to full production. Again, an advantage we have is that the joint venture partner is going to consume the output. So, as soon as we can yield wafers off the line, we will be generating revenue. So it should be a fairly quick ramp up. And we're driving for some upside to the numbers we've talked about in the past. We're also planning on doing assembly for our Tosa Rosa chips in that facility. So these NRE projects that we've done in the past that are going to start to turn into product revenue in the January quarter, several large NRE programs, those chips are going to be packaged and tested in the joint venture facility also. So that's going to give us some advantage from a cost standpoint in making those chips for, in one case, it's a large Chinese customer and there's one North American customer, but we'll do the assembly in the joint venture. So all we've done to date is really focus on the revenue from splitters, and we think we're going to be able to expand beyond that in the not too distant future.
Okay, I'd like to explore that, but just another quick question. Without having to disclose it, I'm assuming then that pricing has been nailed down. Obviously, your processes are just simply being transferred, so you'd have a very good sense in terms of your overall ASPs and gross margins expected out of the gate with the splitters.
Yes.
Okay, and then moving on then.
And we'd much prefer not to disclose that.
Of course.
But it's accretive to our current business model.
So with regards to how you'd like to roll out with other products, you alluded to the Tosa and Rosa. Are those lines currently being built? Is the equipment ready to go?
Well, they're currently being built, and we should be able to start utilizing them in the January quarter.
Oh, so that quickly, okay. So, okay. In terms of other customers then, beyond the splitters, how do you envision something with the Tosa and Rosa? Are customers lined up for that as well?
Well, I'm not sure how much was disclosed of that, of the NRE contracts we had in the past, but the initial production for the first 12 months for the specific chip is going to go to the person that paid for the NRE, and then after the first 12 months, we can sell that chip to everybody else in the market. We can sell derivatives of the chip right away, but we're showing that to customers beyond the initial NRE partner, and are trying to ramp that part of the product line as quickly as we possibly can. The customer that we did the NRE for, and there's actually two large ones, have a minimum ordering quantity in calendar 12 that they have to order from us to keep their exclusivity. And I'm hoping for upside beyond their minimum order requirements. That we'll see.
Okay, so as it relates then to the forecast from the JV for first year of operation, I believe your assumption is really just based on the splitters, is it not? And all these other new products would be upside to that?
Correct.
Okay, great.
We've tried to not be overly aggressive about the joint venture's revenue until it starts to produce wafers, which ought to be this quarter.
Okay. Tim, wondering if you can chat about ZT. I believe the so-called handcuffs have come off, and you're permitted now to take that product and sell into the open market. It was
no, actually not. They're going to start. They have ordered initial sets of the product, and it will ship this quarter. They will start to get their initial kind of prototypes, and then they have a year of exclusivity for the specific application.
I see. Okay. So the clock starts ticking now.
Well, we'll start shipping to them, as I said, this quarter, but in small volumes for prototypes. But their minimum order quantity requirement starts in the January year.
Terrific. Excellent. Thank you very much.
Okay.
Thank you. There are no further questions registered at this time. I would like to return the meeting over to Mr. Thorstensen.
Okay. Well, again, we're, as all of you on the call know, going through a difficult transition in this business to get it refocused back on its core competencies that it has in the components space. We see good growth in that market going forward after what we think is a couple quarter, we and others that have larger marketing staffs than we do see as kind of an inventory correction in the market. There's nothing in the dynamics of the marketplace to expand bandwidth that is going to go away in the long term, so we think it's a good market. We think we can reduce our cash burn going forward, and we're in a reasonable cash position and are extremely excited about not just the Chinese joint venture, but things we're doing with the photodiode business to expand it rapidly. Other NRE projects that we're starting to begin as some of the ones that we're currently completing up with product revenue. So we think there are 6 or 8 growth drivers for this business going forward, and that, in the not-too-distant future, we can get it to a position where it is much more valuable than it is today. So we appreciate your patience as we work through this process, and we will be able to communicate our plans more specifically moving forward as we divest the rest of our systems business. So with that, thanks a lot. Take care.
Thank you. The conference is now ended. Please disconnect your lines at this time, and we thank you for your participation.